Yeah, thank you very much for the opportunity to speak on an important topic at the CPD of ACCE. This is not the first time of presenting at this meeting, but today's topic is an important one: income growth, population growth, and savings in Ghana. I'll be guided by the outline that you can all see. I will first of all talk about the introduction, talk about some facts on Ghana. I will attempt to just relate briefly to some literature. I will talk about the method and data that is used for the work. Then I will also discuss results of the work. Some global outlook. The World Bank in 2013 indicated that whether savings is an affront to economic growth in developing countries is still an ongoing debate. And when we get to the literature, it will be very clear that when we are looking at economic growth, savings, population growth, there is no finality as to their relationship. In the late 1960s, developing countries saved only 18% of their income. And in low-income economies, only 13% do so, as compared to 21% in high-income economies. So that is the variation in the level of savings in the various segments of economies across the world. Developing countries' domestic saving averaged 32% of their income in 2009, while the rate in developed countries had fallen to 17%. This was provided by the World Bank report, page 61, in 2013. Again, by 2030, developing countries will contribute 62% of every $100 of total world saving. This is an increase from 45% in 2010. This is a World Bank outlook of savings as a share of global income from 1980 to 2009. And the graph clearly demonstrates that developing countries' savings as a percentage of global income is lower than high-income countries, and high-income countries are below the world average. This tells us that developing countries need to do a lot to ensure they promote savings among their population. Global savings as a percentage of GDP from 1987 to 2016 also shows some kind of undulating trend, to the extent that in 1987, the global gross savings as a percentage of GDP increased up to 1989 and thereafter fell up to 1991 and began some upward trajectory and show some undulating trend, inched up highly in 2006 and thereafter began falling to 2009 and maintain some stability thereafter up to 2016. So the point is that global savings itself is not uniform over the period. It is undulating, caused by some factors. Some of the factors may be issues relating to population, issues relating to per capita growth or per capita income, or issues relating to human capital development and their contribution to productivity. In Ghana, the Ghana Statistical Service actually provided some important insight in their Living Standard Survey in 2014. It is interesting. The study considered households who are saving and households who are not saving. The study also decomposed the finding into individual having savings accounts, which was actually decomposed into male and female. In the area of household with savings and not savings, urban areas actually provided 46.4% as those who are saving, and 53.6% are those who are not saving in urban areas. In Accra, 54% are saving and 46% are not actually saving. Other urban areas indicated 42.9% who are saving and over 57% are not saving. When we come to rural areas, 21.5% are saving and 78.5% are not saving. In rural coastal areas, 22.6% are saving and above 74% are not saving. In rural forest areas, mostly our farming areas, only 23% are saving and over 76% are not saving. In rural savanna, mainly in the northern rural areas of the country, only 17.6% are saving and 82.4% are not saving. When we combine all these things from urban area up to rural savanna, only 35.4% are saving and 64.6% are not saving. So that is a clear indication that saving is an important area that we need to consider, because it has some relationship with the growth of the economy, it has some relationship with the growth of the population. Again, when we decompose into male and female who are saving, 55% of male are saving and 44.8% of female are saving. What it means is that 75.6% are the one who are saving. 56.3% of male in Accra are saving and 43.7% of female in Accra were the one who are saving at that period. So in all, only 28.2% of combined individual having savings account in other urban areas. When we come to rural coastal area, the situation is such that 70.2% are saving and 29.8% of female are the ones saving. If we come to rural forest area, 67.1% of male are saving and 32.9% of female are saving. Now overall, 58.6% are saving and 41.4% of female are saving. And overall, the indication is that more males are saving than female. And that is another attraction that I think we need to look at to ensure that something critically is done to promote saving among female. And most of the time, savings also goes with productive activity, income generating activity. And what it means is that there is the need to promote greater income generating activity, productivity by women, by providing them opportunities. Another fact about Ghana is that between 1960 and 2017, the Lawrence curve, which actually explains income distribution in terms of its fairness or unfairness among the population, shows that income is not fairly distributed. Of course, unfairness in terms of income distribution is not strange, but attempt ought to be made in order to close the gap. The horizontal line through the origin is actually an indication of a line of equality. And when the distribution is on that straight line, what it means is that income is equally distributed. Of course, we don't expect income to be equally distributed, but we want a situation where the gap between the Lorentz curve and the horizontal, the diagonal line is closer, which will indicate that income is more fairly distributed. But as it is, we can see that the curve protruded out, showing greater gap measured by the Gini index, indicating that income is not fairly distributed. Policies are supposed to be put in place such that when they are implemented, they can close the gap of inequality. They can close the gap of unfairness in income distribution. Income is distributed through many ways. The income can be distributed through the provision of opportunities for people to generate income or to participate in productive activities. The more people are not able to get hands on productive activity, they are likely not to get a fair share of national income. So that is why policies are supposed to be put in place to ensure better, closer distribution of income. Again, population growth over a period of 30 years from 1987 to 2017 indicate an overall 2.54% growth in population. And gross saving as a percentage of GDP also indicate that over that period from 1987 to 2017, the average gross saving as a percentage of GDP was 12.11%. This is a graph showing both GDP per capita growth, that is annual data from 1987 to 2017, and gross savings as a percentage of GDP. I now look at the GDP per capita or per capita income. This also shows an undulating nature, period where GDP per capita grows steadily, and period that it gets to a peak and falls sharply, and thereafter rise sharply and plateau at a point and fall. So the situation, the graph actually shows a peak, a trough, and a rising point and descending point. And all these things have implication, especially for what policies were put in place, what environment the economy is being managed, and what productive activities were taking place at that period. And what is very significant is that if you look at the period around 2007, 2006, 2007, that was the time that we actually had our first Eurobond of $750 million. That was the time that we engaged in redenomination. That was the time that we exited the IMF program of HIPIC program, and we were on our own. So you realize that from 2001 thereabout up to 2005, it's like, even though it is undulating, but we saw some remarkable improvement in GDP per capita, but it fell sharply in 2007. Thereafter, rise, fall, rise, and fall sharply again in 2013, as we can see. That is, the red graph is gross savings per GDP. It is very clear that to a large extent the gross saving mimic the curvature or the graphical trend of GDP per capita. So where GDP per capita seems to go up, gross savings per GDP also goes up, trying to indicate that there is some relationship between GDP per capita growth, and gross savings as a percentage of GDP. The only area where there seems to be some deviation in the trend is around 2010 to 2012. In 2010, we had our rebase GDP, and thereafter we saw the gross savings falling sharply. It is not mimicking the curvature of the GDP per capita at that within that period. That should clearly tell us that rebasing does not necessarily encourage savings among people. Rebasing is just a statistical measure that should prop up the GDP, and for that matter, improving the per capita income or GDP per capita growth statistically. So that has not gotten any direct relationship in promoting savings among the people. This is the graph of GDP per capita on annual basis and the population growth. One can see clearly that the population growth around 3%. It fell somehow and was somehow steady, especially from 2004. It was gradually going up. Some may associate this development to a lot of social policies that were implemented as a result of the demand of the HIPIC initiative, which encouraged a lot of social programs and also programs for pregnant women and the rest. But thereafter, from 2009, one has seen some marginal reduction in the growth rate of population, which is now closer to 2.2% in 2017. So that has been the nature of the development of population growth in the country since from 1987 to 2017. This is the GDP per capita growth, and one can realize that after 1988, our GDP per capita was actually below the population growth rate, and that has implications for economic management. If your population is growing above your per capita growth, that means that there is some disconnect that you need to work on. Of course, in the literature, some will indicate that population growth is good for the growth of the economy, especially when that develop a lot of human capital who can be productive and contribute to productive activity and generate the growth. Some writers or some authors believe that that may not be the case, that population growth above per capita income put pressure on economic management and limit access to social amenities and social services. In 2007, we have seen per capita growth above population growth and fell sharply again in 2009 and fell somehow below population growth, and thereafter from 2011 per capita growth actually was far above population growth. And again in 2010 2011, there are two remarkable things that were actually associated with the Ghanaian economy. In 2010, we actually engaged in rebase of the economy, and definitely that rebasing, all things being equal, promoted some people call artificial growth of the economy, and that artificial growth of the economy result in an improvement in per capita income, and that is one reflection there. Again in 2011, that was the time that we started receiving petroleum revenue, for which there was some dynamics in the contribution to the overall GDP of the country, where we saw GDP grew by 14% for a very long time in 2011. Then these two factors put together actually uh, is accountable to the kind of development we see for per capita growth, which is far, far above that of population growth. And of course, so long as the GDP growth emanated from rebase, and also just as a result of oil production, which brought about one-time excessive effect on the distribution or sectoral distribution of GDP in the country. The economy has actually accepted or has imbibed the contribution of the oil sector to the GDP, and thereafter things have to work their normal way. So it is not surprising that after it peaked in 2011, after that we see GDP per capita falling again in 2014. Uh, in 2014, where we started experiencing severe effect of the what we call doomsday, that is energy sector risk, because of unavailability of power for businesses, for micro businesses, for small and medium scale enterprises, large enterprises to contribute to the economy. It is not also surprising that we saw the GDP per capita fell below the growth of population. Of course, after 2016, we have seen the GDP per capita growing up again. Of course, if we elongate the data into 2018 and then perhaps in future look at 2019, we will see the clear reflection of the contribution of the rebase that have been done in 2018 to the GDP per capita growth. Some literature. In 1984, Hughes argued that higher growth rate of population in the sub-Saharan region thus stifles the overall development of those countries, in addition to the reduction in quality of life and social services enjoyed in those respective countries. So the argument is that growth in population will have some effect on the growth of the economy, productivity. Why? Because you will need to cater for the growth of the population. The population will struggle to get access to quality of life and social services. So youth is actually looking at population growth as something that actually negatively affects productivity and access to social services and quality of life. Tuesnet in 1960 and Simon in 1977 also posited that large population, all other things being equal, will supply the economy with more human capital, which when employed and deployed effectively can be used productively to increase output and income. So there is a sharp difference in the in the way these two researchers look at population growth. While Hughes look at population growth as being negative to income and access to social services and quality of life, QSNet believes that when there is population growth, all other things being equal, this population growth has the possibility of supplying human capital. And when this human capital is well developed, attention is paid to the development of human capital and deployed effectively, this human capital will contribute immensely to productivity, income growth, and output of that country. And the country in general will be founded very well. Blucknell and Schwartz in 2013 also looked at the linkage at the other way around and found a positive relationship between GDP per capita growth and population growth. They believe that an increase in GDP growth will have a positive effect on fertility and at the same time negative effect on infant and child mortality. And what they are saying basically is that when there is a growth in the economy, income expands or income improves, it becomes easy to take care of the needs of the population, and that population will have uh, access to social services, quality of life. Children will not be dying at will. Children will live their full life and they become productive, contributing to human capital formation of the country and make productivity worthwhile. Some basic theoretical model and specification. I use basically the solo growth model, and basically the solo growth model actually relates income or productivity, income or output to the relationship between savings, population growth, and other variables. So basically, the solo growth model is a long-term model. So we will consider the basic model and the augmented model. And the difference between the basic model and the augmented model is that the augmented model has human capital in it, but the basic model does not have human capital in it. So clearly, human capital is introduced in the augmented model. Well, the data used is from the World Bank database from 1987 to 2017. And basically, we look at saving as a share of GDP, working population, which is defined as population age between 15 and 64 years, income per capita growth, and population growth. So those are the data that we pick from the World Bank database and span from 1987 to 2017. We also look at the contribution of technology growth and capital depreciation as assumed to amount to 0.05 in line with literature, or 5% in line with literature on the topic. Now, the result. The result is interesting. Now, income with savings show a negative relationship, but significant at 1%, and income with population growth is also negative, with 5% significant level. Now, the point is, normally we believe that if there is the GDP per capita is growing, that should result in an increase in savings. That is the general norm. But there are situations where the relationship between income and savings may be negative. Why? Because when income is growing or GDP per capita is growing, and at the same time there are opportunity to access credit in the consumer market, where a lot of people can get credit and depend on for their activities, then the quest or the motivation to save will reduce. But where you have a situation where there is no liberalization of the consumer credit market, for which you can easily get access to credit, then you are under obligation and motivated to engage in savings for further investment at a future time. That is the reason why you will find that even though it is expected that there should be a positive relationship between income and savings, but sometimes, like we find in our study, you will now see a negative relationship reflecting the role of capital market development, the role of access to credit to service formation or saving among the population. So, in the augmented model, where we introduce human capital, and the human capital is measured by enrollment in primary school, we can also see a positive relationship, as explained earlier on in the literature, that when there is population growth, that population growth will actually provide for human capital. And when that human capital is developed very well through skills development and education, the human capital become an asset to the economy, contribute to the economy, and thereby having a positive relationship with income or GDP per capita. So this actually follow the conception of literature. And that is why our investment in human capital development is key. And human capital development, especially we are using primary school enrollment as a proxy, does not necessarily mean that we should continue to do the things we have been doing in terms of investing in enrollment in schools. But we should actually focus on a new direction such that we know that science education, technology education is the backbone of better economic productivity among other economies. So we should not say that because in Ghana we are engaged in free SHS, so it means that we are focusing on human capital development. That form of human capital development is the same way that we have been doing in the past 30 to 40 years. This is the time that our human capital development as a way of contributing to income growth within the economy should shift to investment in critical science, engineering, and technical education. That is when we can say that we are meaningfully investing in human capital that can promote growth of the economy in future. Of course, the normality tests show that we do not have anything like multicularity and the rest. So I think the model is robust and good. Now, I have spent some time to discuss the finding, so I will just take this opportunity to just summarize. The effect of saving is consistent with the submissions of Chapelle and Pagano in 1992 that binding liquidity constraints increase the savings rate because young households cannot save as much as they would like. And what it means is that if you do not have access to liquidity in terms of easy access to loans, credit cards, etc. to use, then you are constrained, and as a result, you are motivated to save. You cannot do without saving, because if you don't save, you cannot spend at a future date. If you don't save, you cannot invest at a future date. So, constraint to liquidity becomes motivation for savings. Now, the increase in aggregate savings rate translates into faster growth. By the same token, liberalization of the consumer credit or mortgage market leads to a reduction in saving and growth, or savings growth. Here we have another instance of financial market development tending to reduce growth. And what it means is that savings growth is reducing as a result of access to credit. So you have few people, especially the net worth individuals, actually engaging in the savings. A majority of households would actually concentrate because they have access to credit facilities as provided by the financial market. So financial market development in some way reduces savings growth for households. So thank you. We've just looked at income growth, population growth, and savings. Thank you.